Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the 2 Cents episode of the Australian Property Podcast. I'm Pete Wargent. This is your regular 2 Cents segment. I'm here with Batesy. Chris, how are you?
Life's good here, Pete. Bit of a sick boy. She's only February, so that's a bit concerning. But yeah, lots and lots happening in life and home and business. We've got a big rebrand happening next week, and yeah, lots of exciting things happening. So, how are you doing?
Pretty good. Yeah, I've been. What have I been doing this week? I've been listening to an audio book. I've been meaning to listen to it for ages. Die with Zero by Bill Perkins, which has got me thinking about time buckets and I guess what they used to call a bucket list and prioritizing the things you really want to do in life. So that's been some food for thought. What else? I've been using, I don't know if anyone's heard of this app called Duolingo. I've been learning Spanish. So it kind of reminds you to keep tuning in every day and sort of get a run of lessons going. So it's been pretty good so far, actually. I'll do a few European languages, so I've got a bit of a head start on that one. But anyway, so far so good. If I ever need to ask where the cathedral is in Madrid, I'll be absolutely sorted. So,
I mean, that's an interesting title of the book, I guess. I mean, there's a famous quote, make your last check bounce. I mean, obviously you can tell when that quote was written. It was a while ago when we did used to use checks, but I do think this is it plays into the intergenerational story, right? Like, do you give your money away when you die, inheritance, or do you give it away and see the pleasure of that in terms of, passing down generations or in communities or, charities or, and lots of different options. So, should you try to die with a lot of money or should you try to die with zero? And it's a really good way to start to think about things, because I do think people are dying with a lot of money. And, money sometimes can create problems for people if you give it to them, a bit later on than earlier where it's more opportunities. So,
thought-provoking. Yeah. I mean, the title is obviously provocative, but I guess the point being made is that people often oversave for retirement. And actually, as you said, the intergenerational wealth transfer, if you pile up an enormous pile of assets and wealth and then pass it on, but you might live till 80 or 90. By the time you pass that on, it's not much use to your offspring potentially. And as he points out, if you sort of leave money in a will, you've got no control over what happens to those funds. Whereas if you start thinking a bit more strategically, you can help your kids onto the property ladder, which we're definitely seeing now. I know you called this last year. We're getting so many clients come to us and say, right, I just want to get my kids on the housing ladder because they hate renting. The rental market's a nightmare. So it kind of does tie into what's actually happening right now. And also, I suppose what he's really saying is rather than literally dying with zero, optimize your spending to enjoy life at an appropriate time, not leaving things until too late, that distant future time when everything will be sorted out and perfect, because it often never comes if you do it that way.
And I wonder, usually it's like whatever the experience you went in, whether it was good or bad, you try to either replicate it or avoid it, right? So if the kids have been thinking, oh, God, I wish mum and dad just helped us out a little bit and passed it down a bit earlier, do they just want to be a bit of a hypocrite and then do it to their kids? Well, probably not. They probably go, well, if we're in that position, we're not going to do what our parents did to us and kept it back till they died. And so maybe, when they say when people build wealth, a couple of generations to build it and the third generation loses it, because they become a lot more frivolous with the money. The first two sort of keep it back. It's very scarcity. Let's build wealth for family generations. And the third one says, well, I don't care about this. I just want to live the good life. And they usually blow it. So I wonder if that's going to happen a bit. That haven't thought about that on a deeper level, but it sort of makes sense when you start to think about it. But anyway, 7:00 on a Sunday. Thanks for tuning in. What's the 3 stories we're going to pick this week? Sometimes we can't. We're struggling for the best 3, but this week we had so many choices. So what did you decide on, Pete?
Funnily enough, on that point, I saw McCrindle just released an infographic this week on the trends for 2024, and the Bank of Nan and Pop was actually one of their key trends for this year. So not just the Bank of Mum and Dad, but also 2 generations up potentially. So there's I mean, there's an unprecedented amount of wealth in Australia. It's continued to make record highs every year, really, since the financial crisis. It just keeps on going. So big trends ahead. So yeah, 3 stories this week. Well, we've had a Reserve Bank update this week, not just the monetary policy meeting, but also there's the statement of monetary policy, and in fact a new press conference. So it's a new format now. I'm not so sure about the standard of some of the media questions. I think some work to do there for some of the economics journos. But so firstly, story in the Oz. Coming rate cuts could be a potential double-edged sword for first home buyers. No doubt. I think improving borrowing capacity, but also increasing competition for those entry-level properties. Secondly, another piece in the Oz, actually, home equity access increases for retirees. James Kirby highlighted this new trend, something we've touched on, I think, in episodes before. And then thirdly, some sort of thinking about what's coming ahead. In review, property prices could rise 10% on lower taxes and lower interest rates. So, yeah, I think those tax cuts, they're really sort of giving back some of the bracket creep from what came before. But nevertheless, at least in nominal terms, people will have a bit more borrowing capacity in the second half of this year and particularly next year. So let's start with this, with the Reserve Bank decision this week, Chris. So on hold, I think if you look at all the stuff that's going on around the world, we can probably expect interest rates to be on hold for quite a long time yet, at least a few meetings to come. There's not as many meetings going forward, actually, for the RBA. So I think, we'll maybe come back to this in the middle of the year, but I think in the meantime, interest rates are likely on hold. There's definitely some still hawkish sort of tone in there, but realistic. If you look at what markets are pricing, it's really for lower interest rates over the next 18 months or so. And I think lower repayments ahead, but that's the FINRA, well, as the Australian pointed out, I should say, increasing borrowing capacity for first home buyers is all well and good, but also it means investors will start to come back into the market. And in fact, Justin Faber at Antipodean Charts showed how online searches for investment property are suddenly on the way up again quite quickly. So people are starting to think about getting into the market. And as we've always found, it's often that competition, I guess, between the investor who wants the entry-level property with a good yield versus the first home buyer who's just trying to get onto the ladder.
Yeah, unfortunately, I don't think rate cuts are going to be really great news for first home buyers. You mentioned there around the investors will, be more confident to invest when they know rates have peaked and are on the downward cycle rather than going up over the last couple of years. We have actually still seen pretty strong, numbers of investors come to us over the last 12 months because they've gone, well, I just don't see myself upgrading my home. I don't need to do a major renovation. I can just make do with a smaller renovation. We're just going to, curtail that. Instead of spending 800, we're going to spend 300. And so we've still got this equity. We've still got this borrowing capacity left over. We've still got pretty low debt and it's totally serviceable on low mortgage rates. Or, first home buyers who just can't afford to buy their first home. So they become an investor. And so sometimes you just, they're competing in markets where other first home buyers are buying. And so, yeah, they're a first home buyer, but they're a first time investor. And so I think, the issue when you start seeing rate cuts, when Channel 9 News starts pumping it out there and it's all over the front pages that property prices are going to start going up and rate cuts are here. Unfortunately, that will be when even an additional wave of demand enters the market. And there's always a supply lag. I think that the turnover rate's really going to continue to reduce dramatically, as in people are going to be stuck in their homes longer and longer. Even if they wanted to upgrade, they can't, and so they're stuck there. They have to live there for longer. And what that means is the turnover rate will stay really low. And I think listings will stay really low this year. It's not a market where people are going to rush and make these big property moves. It's more a market where you still sit on your hands because rates are high, borrowing capacity is tight, and it's really hard to make moves. And yeah, so I do see investors start to come back into the market more and more. And first home buyers that, are typically want to buying a first home buyer, but they're an investor. So they're pushing out first home buyers in other sub-markets. The other issue is that when rates drop, borrowing capacity goes up. It's kind of like a double win. You pay less, but you can also borrow more. And what we've seen in the past is borrowing capacity very linked to price growth. Even though, and that was what the big surprising thing was in 2023 when rates went through the roof, or 2022, and borrowing capacity fell, but prices didn't fall anywhere near as much as borrowing capacity. So that was like out of sync. But correlated longer term, and this is why I guess big figures like Chris Joy got it wrong a little bit, is they were banking, well, if borrowing capacity falls, rates go up, prices will fall, because that had correlated over the longer term. And so what we're basically saying is that if borrowing capacity goes back up, that'll very quickly be spent, because everyone's already spending every dollar of their borrowing capacity. You give them a bit more, they'll spend it because they have to, and prices will go up. So, yeah, a lot of investors and first-time buyers are trying to get ahead of this. And I would say the time to get ahead of it was actually last year. So you're already in a competitive market, and more competitive than it was last year, I would say, even though rate cuts haven't happened.
Absolutely. I think money markets are pricing for a couple of interest rate cuts potentially this year. All four of the major banks are now looking for interest rate cuts in 2024. The Australian pointed out, Rate City analysis shows a 25 basis point cut. In round numbers, I guess cuts $150 a month off $1 million of debt. So if you get two cuts, $300 a month, and so on. I guess this is like the antithesis of what we saw last year when interest rates were going the other way, as you said, and it was really a huge jump on the average loan. $1,200 on $500,000 of mortgage debt. So a huge increase last year, but it didn't really slow the market too much. Ray White, chief economist, Narrowed Economy, said interest rate cuts would result in prices exceeding growth in 2023 and surpassing 10% on an annual basis. I think your point on turnover there is very valid. I think partly because we're just not seeing there's many high-rise towers or apartment blocks being built. So if you don't have people buying into the new stock, well, a lot of people, you would think it would help turnover, but it doesn't, because people are just staying put. People are staying in existing properties for longer. They're choosing to renovate. We've got renovations back at pretty much at record levels again. The lending for new homes or the construction of new homes is basically a record low now, the HIA showed. So, what are we seeing so far this year? A lot of people coming in, a lot of competition, stuff selling very quickly. It's not the same all over the country. I think at the macro level, SQM showed, it's the usual seasonal trends around December and January. But if you look at just the big picture, a couple of 100,000 properties listed for sale around the country. But if you went back a decade ago, it was in the high 300,000s, 50% higher, basically. And that's the big picture. We've got a bigger population, not as much property for sale. So when something good comes up, you can see the competition. And I think in tandem with that, I've just seen some examples in recent weeks of enormous increases in rents. Not everywhere, but just in parts of Sydney. People are getting renewals come through, and then suddenly 50% increases and all kinds of wild stuff happening. So that shortage story is clearly going to be a part of the picture in 2024 as well.
Yeah, absolutely. The rental crisis is the last thing that I guess you needed in this situation. You've got a housing affordability crisis, you've got a rental crisis, and you've got a mortgage affordability crisis. No matter where you are in that spectrum, besides the baby boomers that have got no mortgage and very low debt and they've got money in the bank and are loving higher interest rates because it means a better return on their cash, a lot of other parts of the market are sort of feeling it. Not only the ones in the market, but the ones who are renting as well. So, and I do think that, encourages people to buy. Even though rates are high, they go, well, I'm not sure I can rely on the rental market to deliver what I need from a shelter and a lifestyle point of view for my family long term. And so that insecurity there, instability and concern there is forcing people to buy. And that's one of the big fundamental things that's really getting, I guess, the veil has been lifted on that. We've been talking about that for many years, how the challenges with renting is getting harder and harder in the suburbs that people want to rent because the markets are shifting more and more to owner-occupier and people are living in those properties longer and longer. But I think that's really only come to light widespread in the last year or two in our capital cities. What's story number 2, Pete? Because I think this is a very interesting story. I read this before you sent it to me, and I do think this is not another good news for housing affordability. It really slows the turnover rate even more.
Yeah, I would say on that actually, even though we've got record prices in a lot of parts of the housing market, it's not everywhere. I've definitely seen in some regional markets prices just not achieving the same levels as they would have done in the frenzy. And actually, even in Brisbane, we've seen properties that would have been bought by somebody to build or develop, maybe selling for 10 or 15% less than they were at the real peak of the frenzy. So yes, we're probably at the median price level, got record prices have been recovered, but it's not everywhere. And there are some decent deals around, but you do need to sort of pick the eyes out of it a little bit, because as you said, stock levels are very tight. So yeah, second news story of the week, home equity access for older Australians. So James Kirby in Australia, this one stuck under the radar for me a little bit. Is this the best kept secret for older Australians? So the government's home equity access scheme is now appealing to a wider group of cash-strapped retirees, said James Kirby. Investors can boost retirement money by up to $1 million through the scheme. So the government will allow a super low lending rate of about 3.95%, and it's accessible for borrowers who are over 67. They've got at least 20,000 of equity in their home. And financial advisors can now recommend, I guess, older Aussies can borrow money at 4%. And I guess, like, for people who've got access to it, I mean, that's money that could be invested, and the average returns on super have been much higher than 4%, I guess, over time. And I think this is just a theme that we have sort of glanced across a few times before, and that's that more people are taking debt into retirement. People aren't quite as fearful, I suppose, of debt as they were a generation ago. And we know there's a lot of retirees in Australia with enormous amounts of equity built up over long periods of time. So what do you think? Any impact from this, Chris?
Look, I think there's there are limits to this home equity scheme. But what it means is that people who are running out of cash, they've got no money in their super, they've got heaps of equity in their home. They don't really want to sell their home, but some people are forced to sell their home. And because it's not included in the pension test. So you can get the pension and have a $4 million home paid off. So these are issues that I think will come to light more and more over the decades to come, because these inequalities will start to be highlighted more and more. And I do think that, tax settings are going to get more and more, potentially tax CGT on capital growth on your homes and things like the pension test. So what we're basically saying is that person, though, could go to the government and get a loan or top up their pension under this home equity scheme. And these sort of reverse mortgages were really in the vogue maybe 10, 15 years ago, but there wasn't that much demand for them. But they're really starting to come back into fashion. We had Brian Hartzer. He had launched a company called 2B, which is kind of another home equity property, loan for retirees. And I think these reverse mortgages, if the banks can get around the compliance issues and the issues where potentially people get kicked out of their home if they take out a home equity scheme and then have to sell because there are issues that, they don't want to get on tonight in a current affair if they kick people out of their homes. There's a social sort of challenge there. But I think reverse mortgages are going to start coming back. The government's basically encouraging it, right? The negative of that is, it keeps that person in the home. The negative of that is that it stops them selling. And that stops the turnover rate, which keeps supply really tight in the market. And it's usually an inefficient use of resources. I'm not saying that all baby boomers have to sell their property because they're wasting, got spare bedrooms. I think that's pretty harsh to say that they've owned that property, they've paid the mortgage, they've owned it for 20, 30 years. They have to leave now because of the societal problem. But that is one of the issues that we do need. We need to repurpose our property supply for the people who actually need it. So the family that's stuck up in a 2-bedroom apartment with 3 kids, and then you've got 2 doors down, a person by themselves in a 5-bedroom house. It's not the right allocation of resources, but it's not that black and white, right? You've got people in these homes that, and who's to say they should be forced to do things like that? But the tax settings does encourage it just to stay, and the kids are encouraging them to stay in their property. So, yeah, that's my concern around reverse mortgages, is that it actually doesn't do anything great for property prices. It actually pushes prices back up.
My understanding for Australia historically is that reverse mortgages weren't that popular, partly because there were different risk weights applied for banks, so they weren't really that bothered or keen to get involved. And also, there's a bit of a reputational risk, as you said. You don't want to end up on Today Tonight, with somebody complaining about irresponsible lending. I think actually this goes back to what I was talking about at the start with the idea of the time buckets. I mean, there's really only a window here where a retiree who's 67 and above is going to think about using this stuff. At 67, yes, maybe, but a decade on, you're probably you're thinking more about aged care and health and that kind of thing later on. I think so. There's a window there potentially where people might use this stuff, but yeah, I don't know about the risk weighting on this stuff. I mean, all four of Australia's big four banks are now among the best capitalised, if not the best capitalised in the world. And I saw the IMF was chirping away this week about the potential for more home loan curbs in Australia. I don't know what they've been smoking there, because we've already got major issues with housing supply, and part of that is driven by the extremely large lending assessment buffers that are put in place. So anyway, we'll see whether that has any impact. If anything, yes, it might just free up some capital for retirees if it becomes more popular. Certainly the ability to borrow at under 4% would be appealing, that's for sure, in the current environment. So, Chris, third story of the week, property price forecast for 2024. We don't talk too much about annual forecasts on the show if we can avoid it, because it's more the underlying themes we're interested in, because I guess everyone likes to throw a dart at the dartboard. But yeah, what a turnaround from a year ago. We've got Ray White and Jarden both looking at significant price increases, I guess, as touched on, driven by lower mortgage rates, tax cuts, and so on. Radom Syed from Confidence Finance said a 0.75% cut in rates increases borrowing capacity by about 12.5%. So I guess it depends on the mortgage and your situation and so on. But yeah, it's notable because Gareth Aird of CBA is now predicting 3 interest rate cuts in 2024 and another 3 interest rate cuts in 2025, which would take the cash rate target to under 3%. Now, if that plays out, as Radon points out there, that would increase borrowing capacities by a quarter or thereabouts. So, but yeah, I mean, I'm not so sure about tighter lending standards. We saw yet again this week another construction giant, this time Sydney-based, went down. 20 projects halted. A huge pipeline of work under the QBC now thrown into complete disarray. Construction insolvencies are up by 50% from a year ago. So the shortage thing is clearly a big part of it. But overall, it looks like most of the forecasters, like Mr. Cacho at Jarden and also Ray White, they're looking for a pretty positive year for property, largely because we've got the interest rate cycle peaking, shortage of property, big population growth, and a rental shortage. I suppose all of those things feeding in. And that was a Fin Review piece, I should say.
Yeah, so Radam's a good friend of mine. We chat very regularly, and he's done some amazing research around borrowing capacity. He really understands that world, and he's one of the best mortgage brokers in the country. So shout out to Radam there. What he's sort of highlighting is that first point we discussed around the linkages between borrowing capacity and credit growth and property prices. And, you increase borrowing capacity, it then leads to higher property prices. Carlos is another good friend of mine. He's been on the show. And, it's interesting watching Jarden's, because they get a lot of the banking data. They know everything behind the scenes. They're constantly, they're like analysis, right? Basically, he's a chief economist at Jarden, which is a big sort of management consultancy, I guess you would call it. And they've been a little bit bearish, to be honest. But I think what he's made some really amazing points over the last 12 months, and, the issues with who's driving the market. It's the higher income part of the market. CBA's basically said, look, our average incomes are higher. So it's the higher income people who've still got borrowing capacity that are transacting. And so what that means is that, inequality is getting worse. The people on the lower incomes are the ones who are getting hit the hardest, A, because they're less likely to own, so they're getting hit with rental increases. And B, if they do want to buy, they haven't got enough income to get, because borrowing capacity is really tight, to enter the market. And so that's basically pushing, more and more people into the market at the time when you want to be entering, when prices were a bit better. And so when prices go back up, borrowing capacity goes up, but then someone needs to buy, has to pay more. And so the real issue, it's a catch-22 at the moment. If they increase borrowing capacity, prices will go up. You're starting to see that, Shane Elliott at ANZ, the old CEO at NAB, I think there's a new CEO now this week. But they were basically saying, we need to increase borrowing capacity because first-home buyers are getting pushed out of the market, and that sort of conversation it's a little bit of we increase it, but prices go up. Okay. So it's in the bank interest to increase borrowing capacity because it increases credit growth. Unfortunately, if we see borrowing capacity go up and tax cuts, Radin did some great research around tax cuts as well, and how tax cuts increase borrowing capacity. So if you get tax cuts plus rate cuts plus assessment buffer changes, that's, a lot of wood on the fire when you've got very low listings. I don't think people are really rushing to sell. Arrears rates aren't up. People are holding on. Yes, their saving buffers are going down. There's been a lot of an argument that, 2023 was a year where everyone used their savings. 2024 is a year where they've got no savings left. But I think people are thinking, well, if I can get through this window because rate cuts are coming, I'll do everything I can to hold the property because it's going to get easier. It's not going to get harder. And so that's why this, inflation getting under control, getting closer down to that 2 to 3 band, it's giving people the confidence to say, well, if I can get through this, rate cuts are coming and I don't need to rush to sell to get out of the market, which might have been a different story, Pete, right? Like nothing was guaranteed. But, you would say that this year has started off better from a data point of view and inflation point of view around the world. And it's become much more positive in the last 3 months versus what it was even back in November.
Completely, yeah. I think there's probably one flip side to this story, and that is if you look at the economists like Deutsche, Shane Oliver at AMP, they're sort of talking about, interest rates will be cut around May or June or thereabouts. But, I guess the flip side is that normally interest rates being cut is a sign of a weakening or a slowing economy. So we've got unemployment at the moment. The unemployment rate's still under 4%. But, if that starts drifting up, 4.5% or even higher potentially, well, that's really the other side of the interest rate story. And if interest rates are falling, that's not because the economy is going gangbusters. It's going to be the opposite. So I suppose if there's a risk for the housing market, or at least the other side, I suppose, to what you were saying about fuel on the fire, there is if more people are losing jobs, if we do see potentially just a slowdown in wages growth and a slowdown in the economy and confidence and all that kind of thing, well, that would sort of keep a lid on house prices potentially. And so, I think you're right. Most people, it seems, are hanging on. Listings aren't particularly picking up all that much. I think people are seeing across to the other side of the interest rate cycle, if that makes any sense. But I think there would still be some trepidation, I guess, for people in more sort of tenuous forms of employment. So I guess that's the thing to watch. If the economy really starts slowing, then the interest rate cuts might reflect, I suppose, the slower conditions.
Yeah, I do think there's a bit of a concern around what's my income going to be next year. Am I going to get that bonus? Am I going to have a job? There has been some redundancies. There's, but I've got a lot of clients in the tech sector, to be honest. And, you look at their incomes, a lot of it's linked to shares as well. Share prices have been booming. So, if there was a bit of a stock market crash or something like that, I think that would actually be a good thing for property prices because it would probably slow down people's confidence around what's coming in the future. And I do think that's slowing down. So if there was, unemployment was staying really low and people were very confident in the next few years, that would be the last thing we'd need for property prices. It would actually be pushing them up, a lot faster. However, when we're talking 3.5% to 4.5% unemployment rate, that still means that, 95% of people are employed and the people in the market. So, yes, that may increase people selling a little bit. Yeah, if they lose their job, they've got no buffer. They most likely would go on a bank payment holiday, hence, and they would do everything they can. They'd probably lean on family at that point in time and try to get back into work pretty fast. So yeah, there might be some more listings if for those people that lose their jobs, but there's a lag. It doesn't just happen straight away. You don't lose your job and then go put your property on the market the next day. It just doesn't happen. So I would still say that, the 95% that are put in the market doesn't mean everyone wants to buy, but there's a subset of that 95% that are doing very well confident around their short-term financial solutions. And they're the buyers. People don't enter the market. They enter the market when you're confident around your income. You don't enter the market when you're getting close to retirement and leverage up. It's usually the people who are, the first-time buyers doing really well. They're getting the pay rises. They're working their way up in the careers. They're the ones out buying, or the ones a little bit older and, their careers are more advanced, or they've started a business and things like that. They're the buyers in the market, whether they're investors or things. So I would say there's enough buyers there that are doing well to offset potentially, that slowdown of, confidence around price growth. And that marginal buyer theory is something I think people should really keep thinking about with the property market. It's not so much what everyone's doing. It's more a case the sellers and the buyers in the market right now, how are they feeling? And is there a supply-demand imbalance?
Prices are set at the margin. I do know, just I suppose anecdotal, but we've never had as much inquiry as we've got right now as buyers agents. We're mainly Southeast Queensland focused, but particularly for the residential space, a little bit commercial as well. But it's just, I think what's happening overall is people have decided they want to buy. Stock levels are low. It's really hard to find something good. So people are passing that problem on to a buyer's agent. So we talk about double-edged swords. That's the thing for a buyer's agent. You often get busy when it's hardest to buy. And when it's really easy to buy, well, nobody wants to. That's the cycle. But it does suggest to me, certainly for the eastern seaboard, it looks like most markets are going to have a good year, just based on what I've seen so far. Perth is booming anyway. It's an interesting time. So just to wrap up on those three stories, potential interest rate cuts a double-edged sword for first-time buyers. Can't disagree with that. Home equity access may increase for retirees under the government's revised home equity access scheme, and some property price forecasts from Ray White and Jarden and others, basically looking at the impact of lower interest rates and taxes. So, Chris, I guess you guys will be flat out with a merger, but if people want to get hold of you, where should they look you up?
Yeah, absolutely. We've got a much bigger team now. We're probably closer to 50 now. So absolutely, if you just have a look in the show notes, there's a type form there. Fill that in and the team will reach out and see if we can help. There's been hundreds and hundreds that have come through the podcast now. So, we'd love to help. And, it doesn't surprise me, Pete, what you're saying there is, once people start to be in the market, and I think a lot of people in the market now are those experienced, the buyers that have been a bit burnt. It's not so much the person just, I woke up today and I want to buy tomorrow. There's always a lead time for people entering the market. I think it's that pent-up demand buyer. The one who missed out in 17, 19, 21, 23, they still haven't done the upgrade, or they still haven't entered the market. They're the ones that are the pre-approvals we extended a few times. We had a client buy this week that's been wanting to upgrade out of Sydney, up the coast, the Central Coast. It's been 2 years, finally got something. And so it's those buyers that have the confidence because they've seen it all before and they've been burned a few times and they want to get ahead of the wave.
Yeah, we've had a couple like that where people are very relieved to get something bought after a challenging journey, especially for units in Brisbane. Stuff's just selling so quickly at the moment. So, give us a shout if you're looking to buy. It's tough conditions out there, depending on where you're looking, pretty tight stock. And some big numbers for the podcast this year as well, Chris. I'm looking forward to that. Don't forget to share on socials and let other people know, because the more the merrier, and we're getting some really good numbers now. So happy days. So enjoy the rest of your weekend and look forward to catching you next time.
Absolutely. Thanks a lot, Pete. And thanks for listening, everybody. We'll talk to you all next week.